So, good day to everyone who has joined us in impressively large numbers from all over the world. Europe, Asia Pacific, all points in between, Africa, the Americas, MENA too. I'm Stuart MacDonald and I'm delighted to moderate this, the latest in distributed ledger technology, or DLT, and crypto assets investment experts Arrow Capital's thought leadership series of educational webinars. Today's is entitled Two Sides of the Same Coin, Blockchain as Technology and Money, and it is organized in partnership with DBS, the well-respected Singapore headquartered banking and financial services group. These webinars are designed for investment professionals to learn more about this fast-growing, often complex and fast-maturing space, still often misunderstood, and also the exciting, dare I say, the huge investment opportunities that it presents. Now, we're seeing serious interest from serious players, from Fidelity to Goldman Sachs and JP Morgan to sovereign wealth funds and central banks. This is all coming into this space, and Arrow Capital is the first player, to my knowledge, with a truly institutional quality multi-manager approach to it. Arrow's approach is very research intensive as well as structured, and this is reflected in what we'll hear from Peter Habermacher, Arrow Capital's chief executive and co-founder. He'll address the question, should DLT and crypto assets even exist? Then, delighted to welcome, we'll be hearing from Timur Beg, Managing Director and Chief Economist at DBS Bank, joining us from Singapore, who will be telling us about the subject of his recent paper, CBDCs and their implications for the future of fintech and banking in Asia. Now, very quickly, a bit of housekeeping. If you have any questions, please put them into the chat room that you will see on your screen. Or if you have the means to contact us by email, email us the questions. And clearly, if time limitations prevent us addressing all of your questions now, please get in touch and Arrow or DBS will answer them offline. Also, the presentations being used will be available to download via the handouts function. Now, without further ado, over to you, Peter.
Thank you, Stuart. So, most fundamental question of all for kind of any investor active in this space or kind of looking to enter this space is, why should this asset class, why should this technology even exist? What problems does it solve? So, Industrial Revolution has happened in 4 key stages. The first Industrial Revolution was the true Industrial Revolution in the sense of the term, and centered around mechanization using water and steam power. The second Industrial Revolution was the Technological Revolution, which around mass production, assembly lines, and electricity. The third Industrial Revolution was the Digital Revolution, which centered around communication technologies, automation, computers, and electronics. Today, we find ourselves entering Industrial Revolution 4.0, or the Data Revolution, which centers around cyber-physical systems, digital scarcity, automated decision-making, and networks. So technologies such as Internet of Things, artificial intelligence, big data are all about effectively integrating and using data in different ways. Some of the largest companies today, from social media platforms to search engine advertising to Amazon's marketplace, predominantly data-driven business models. The World Economic Forum pegged the global data economy at $3 trillion back in 2017. DLT is a new kind of database technology, key to enabling the data sharing and flow required to unlock the full potential of these data-intensive technologies. A key limitation for both data integration and next-generation data technologies are the current data business models. They use data and network ownership to gain market power, which has led to data silos that cannot talk to each other. Value, identity, and ownership have to be verified by a trusted intermediary. It is the incentive and control structures surrounding data which have posed some of the greatest challenges for data digitalization and integration initiatives, such as the digitalization and sharing of medical records. Regulations such as the EU GDPR is designed to help individuals better control their data, but this regulation is expensive to comply with and is often not conducive to incentivizing the data sharing and flow required to unlock the full potential of the fourth industrial revolution. So, where does DLT or distributed ledger technology fit in? DLT is first and foremost a new database structure, database control, and database ownership technology. There are various components to an electronic database known as layers. DLT provides various innovations at the control layer and the network layer, which manages who has access and control of data. The defining characteristic of distributed ledger technology is how it achieves its distributed architecture where there are no database focal points. In this architecture, many parties can have their own copy of the database, which is truly independent of everyone else's copy. This innovation by DLT has several key benefits. The database is more resilient to outside attacks, more tamper-resistant, more transparent, more auditable, and allows for greater control by users and data subjects. This can align the incentives of data subjects, data owners, and data controllers. This reduces the need for intermediaries to facilitate data sharing in low-trust environments between external third parties. Well-known industry names are embracing this new technology. This technology is cutting costs and digitalizing processes which were left behind by previous digital technologies. For example, HSBC has put $10 billion of private placements on the blockchain. The platform known as Digital Vaults gives investors real-time access to records of securities bought in private markets. This has digitalized the paper-based records of private placements. HSBC has also been settling hundreds of billions of dollars worth of internal FX trades on the blockchain, cutting trading costs by 25%. IBM helped businesses integrate blockchain into their processes. IBM offer a full suite of blockchain-based solutions from design to operations. For example, IBM have partnered with Merck to build blockchain platform TradeLens to track shipping containers. The network now covers more than 60% of the global shipping volume. Further, the Central Bank issued a $1.6 billion government bond on the IBM blockchain, and New York also used the IBM's blockchain-based digital health pass to roll out COVID-19 vaccine passports. IAG have launched their blockchain-based trade finance platform Contour to simplify letters of credit, reducing the amount of time needed to process them from 5 to 10 days to under 24 hours. Contour now has expanded to 21 banks from its initial 8 founding members. IAG have also invested in securities lending platform HQLA, which uses blockchain to facilitate efficient and high-speed trading for high-quality liquid assets. HQLA has also recently seen investment from other big banks like Goldman Sachs, Citigroup, and BNP Paribas. Walmart have teamed up with IBM to infuse blockchain into its food supply chains. Using the IBM Food Trust Network, Walmart have shown that they can track a food item from store back to source in seconds compared to days or sometimes even weeks previously. As of June 2020, there are about 300 suppliers and buyers on the network with 6 million packaged goods on store shelves. However, DLT consortiums often struggle to gain widespread industry adoption. The economic issues preventing widespread data sharing are inherent to centralized database control and ownership. Many companies want to be able to directly profit from creating their own DLT platform using traditional business models where they are in control. This makes companies reluctant to join a competitor's DLT platform, as it means foregoing the potential profit from their own platform and giving their competitor a commercial advantage. And this causes the same old problems for data sharing. The solution is decentralization. This is not the first instance where decentralization has achieved a better outcome. Going back to Economics 101, Adam Smith's famous invisible hand shows how when incentives are aligned through the appropriate mechanisms, everyone generally acts in a socially beneficial way. The bedrock of capitalism is that decentralization can have better outcomes than centralization. With decentralization, the decision maker and the decision subject are one and the same, and benefits or suffers from the consequences of their own decisions. Further, market prices provide the information required to make better decisions and incentivizes innovation. DLT takes this one step further, as certain processes which before DLT could only be effectively centralized, money, digital value creation and value transfer, proof of ownership, creation of networks. DLT can decentralize and generate better outcomes. In our economy, money is the core incentive alignment and coordination mechanism where the value of a currency is intertwined with the success of the nation's economy. For DLT, the native cryptocurrency fulfills its role where the value of the cryptocurrency is linked to the success of the DLT platform. This results in a trustless environment not dependent on any local laws or trusted institutions, where the incentives of network owners and users are much better aligned. While DLT is a technological innovation, crypto assets are the economic innovation, and they go hand in hand. Decentralization of control enables DLT to solve three fundamental economic issues. The first is the disintermediation of trusted intermediaries, helping cut out expensive middlemen who might also gain excessive market power. The second is the disintermediation of the holder problem, enabling companies to undertake investments together more confidently in mutually beneficial projects without fearing that the rules of the game could be changed unilaterally by the network owner. And the third is the disintermediation of network monopolies, providing a potential solution to the competition concerns regulators and legislators globally have around the tech giants who benefit massively from the network effects of their platforms. The shared ownership of the network can also generate a vicious cycle of growth using tokens to incentivize participation and contribution to the network. Crypto is a next generation value-based internet, as HTTP and HTML are the platform of the World Wide Web. Ethereum and other crypto networks are the platform of Web 3.0. Web 3.0 is the integration of Industrial Revolution 4.0 technologies and native value management into the internet. So far, the financial payment rails have been kept separate from the web, but in a world where data, money, and value are so intertwined, this separation makes less and less sense. Unlocking this potential value, again, all revolves around data sharing and flow. The new Web 3.0 business models and infrastructure stack are inherently better at achieving this integration than the current Web 2.0 business models and infrastructure stack due to decentralization enabled via DLT. However, as with any new technology, functionality, efficiency, and user-friendliness takes time. But dismissing crypto because of the limitation of the base Bitcoin platform is like dismissing the World Wide Web in the early 1990s. Software built upon the Bitcoin network is increasing its usability, which is similar to how the web has evolved since its inception. The second generation of crypto platforms enable more native functionality via smart contracts, virtual machines to run decentralized software, and more user-friendly, powerful programming languages. The current third generation crypto platforms solve many of the key limitations of Bitcoin. They are much more scalable and do not require large amounts of electricity to run. Taking a step back for a minute, what is the point of all this innovation? Web 2.0 creates value by tackling the same old problems that innovation always has, but just using new business models and technology to do so. For innovation to be useful, it must either cut costs or be able to create value, new value for producers or consumers. Web 3.0 cuts costs by increased automation, removing middlemen who are no longer required, and improving market efficiency. Web 3.0 can create and capture new value by enabling the creation of new markets which can monetize non-tangible assets by creating digital scarcity and removing data silos, allowing greater data control and to use data to optimize markets. In the same way that the web today enables many services, software built upon Web 3.0 is already providing a wide range of valuable services to consumers. For example, decentralized finance now provides many traditional financial services from payment processing to trading infrastructure to borrowing and lending. Over the past year, decentralized finance has grown from around $1 billion to around $60 billion in assets locked in DeFi protocols. Crypto assets can be divided into several distinct groups, each with their own defining characteristics. There are two broad top-down approaches of grouping crypto assets, the regulatory and technical approaches. In the regulatory approach, one can distinguish between three broad categories: the cryptocurrencies, security tokens, and utility tokens. However, stablecoins not clearly fit within any of these categories. From a more technical point of view, we can distinguish between two types of crypto assets: cryptocurrencies and tokens. Cryptocurrencies are act as an incentive and coordination mechanism that prevents attacks aiming to corrupt the data stored on their ledger. Without a well-designed cryptocurrency, a permissionless distributed ledger is of little use as it cannot be trusted. There is no central governing body maintaining the integrity of the platform. A token is a digital representation of an asset. It is issued within a distributed ledger network where it can be traded. The assets that the token represents can be a real world or purely digital assets. Examples of real world assets that can be tokenized are commodities, fiat currencies, real estate, or even the future earnings of an MBA contract. Examples of purely digital assets are reward tokens for participating in or contributing to a network or project. There are many different types of utility tokens. So there's utility tokens, payment and access tokens, work tokens, reward tokens, security tokens, all of which work differently and have distinct functionalities. Then there are stablecoins. Stablecoins are crypto assets designed to have low price volatility to make them more useful as a means of payment by linking them to a stable asset or basket of assets. A stablecoin can be pegged to a currency or a basket of currencies, exchange traded commodities such as precious metals or industrial metals or other crypto assets. An example of a stablecoin is Denim, a global stablecoin in the works of Facebook, which will allow Facebook users to seamlessly pay for goods and services on the Facebook platform without any external payment infrastructure which will charge additional fees. Central bank digital currencies are a central bank issued competitor to stablecoins in terms of a means of payment, which provide various pros and cons relative to stablecoins, depending on a particular use case. Finally, we believe that understanding the economics is important when approaching this market. We have invested a lot of time in building up our economic framework to ensure robust economic support for this growth story over a long time. Alongside our economic white papers, we have published over 50 articles on the economics of DLT and crypto assets as part of our thought leadership series on our website.
Well, Peter, that was terrific. One or two sound issues that happen sometimes with demands on bandwidth, but I'm pleased to say that I myself have received a number of questions directly from different people who are participating. And also a bunch have come into the Q&A section of the chat. Now, I'm going to call one or two of them at a time to you, Peter. It's up to you within the time available, which of these you decide to answer. We can see something from Ernest Lowe. We can see something from Zahid Hussain. Also in London, we've had a question by email from Clive Snowden, which is about how do cryptocurrencies enter the real world, since he has found it impossible to pay money from a UK account into the FCA regulated and US listed Coinbase. Clive, that may be too specific for the purposes of this webinar, and I think we'll come back to you separately about that. I think that we'll go into some of the other ones. Here's one from a Sorty No in Osaka in Japan. Peter, how to value crypto assets? That's one question. We also have another one which comes from an algorithm in Dublin in Ireland. What use cases beside financial services are already the most established or developed? Do you want to pick up on one of those two or both? Then we might go into Ernest and Zahid's questions.
Yeah. So how to value crypto assets? First, there are many types of crypto assets, each with their different functionalities. And kind of crypto assets are security tokens that generate cash flows. One can use discounted cash flow models for. But things get really interesting when you get to the likes of cryptocurrencies like Bitcoin and Ethereum. And there are a number of possible approaches to this. First, one can look at the value of the markets or the asset classes that crypto assets could potentially disrupt. For example, for Bitcoin, people argue that one can calculate the value of Bitcoin if it were to capture X% of the gold market or the offshore banking markets. Second, one can try to measure the network value, which is the approach originally used to value social media networks, especially before they started to effectively monetize their platforms. For crypto, we can look at metrics such as the number of crypto wallets and its growth rate. Third, we can try to measure the value the crypto platform is generating for its users, or in essence try to measure its GDP and wealth creation generation. This involves looking at so-called on-chain indicators, which is metadata on how much these platforms are being used and how much users are willing to pay to use them. This involves looking at things like transaction fees paid by users, the circulating velocity of the cryptocurrency, and the capital gains enjoyed by holders of the cryptocurrency. Based on this approach, we have developed proprietary market indicators which have been effective and continue to be effective at measuring market health, predicting the future direction of the market, as well as predicting market tops over previous crypto market cycles. And this enables us to rotate between aggressive and conservative strategies to capture more of the upside in bull markets and to protect bear markets.
Okay. Actually, Peter, I like the look of Ernest Lowe's second question. It's about security. Cryptocurrency exchanges have been hacked. Does the fund use exchanges? How do you, and more importantly, how do you reduce the risks of holdings being hacked?
Yeah, this is kind of a topic that has been in the news for several years now, particularly as kind of institutional investors have found this particularly troublesome. Kind of the core issue here is a lack of regulation around minimum cybersecurity standards of service providers in the crypto space. And as we've seen in the traditional space, this is kind of a steady evolution of figuring out what is best practices and regulators spending time conversing with the community to come up with a pragmatic and sensible, but most importantly, kind of secure way to regulate the minimum standards or what the minimum standards should be in each jurisdiction, depending on the services that are provided by that service provider. In terms of exchange hacks, or well, in terms of reducing risk, the best way to store private keys, which are the kind of the way to control crypto assets, is to store them in cold storage solutions. And kind of there are many ways of doing that, like paper wallets, hardware wallets. For more institutional investors, they tend to look for kind of professional custodians, and there are now a number of custodians regulated to hold crypto assets in various jurisdictions, and kind of in countries like Germany, banks are now officially allowed and be regulated to hold Bitcoin on behalf of clients with the correct security procedures and processes in place to securely secure them and minimize the risk of any hack.
Okay, Peter, we've literally got about 90 seconds, 2 minutes left, that's all. Zohaib, I don't think that we're going to address where do CBDCs tie into this, simply because Timur is going to be talking about CBDCs, and he may draw the relationship clearly or not. But I just want to ask another question that's come through, Peter, very quickly. With the growing number of Ethereum rivals, how will this further impact the market, especially in terms of the heterogeneous landscape, or in what direction will this go, in your opinion?
Given the kind of network effects, we are likely to see kind of market consolidation into kind of a few key players, each with their kind of key advantages for particular use cases. As to which platform will be the winner, I mean, that's essentially the $64 billion question. And while Ethereum currently has the community around it and first mover advantage, which is obviously very hard to displace, some of the kind of third generation protocols have very interesting use case and technological propositions, but the best technology doesn't necessarily always win. But we are likely to see kind of a range of different crypto platforms, each specializing in their own specific areas. We've seen, for example, in social networks where we've got LinkedIn for kind of professional kind of interactions, got lots of Snapchat for kind of more video and more kind of like day-to-day use. But they each have their own little niche. If that makes sense.
Okay. Peter, I wish we had more time, and time's onward march is always the great enemy of interesting conversation. And Charlie, I'm sorry, we won't necessarily be able to address your question in the time available, but we'll make note of it and we'll get in touch with you offline. I'd like us to move straight on. Thank you again, Peter. That was very, very interesting. Let's move on to our session with Timur Baig, Managing Director and Chief Economist at DBS Bank. And as I mentioned before, he will be telling us about the subject of his recent paper, CBDCs and their implications for the future of fintech and banking in Asia. Timur, over to you. And please, people, keep emailing in or using the chat function, the Q&A, to bring in questions.
Thank you, Stuart, very much for the introduction. And Peter, a great presentation. I enjoyed it very much. Look, I'm going to talk about 4 things about CBDCs in general, but I will not spend too much time on that because I want to focus on the really exciting things that are happening in Asia. And I'll give you 2 pilots, if you will, from China and Cambodia to really get our crypto CBDC juices going, because there's a lot going on in this space and it's all terrific. But before I start, just one point. The big announcement yesterday was that DBS and JP Morgan and Singapore's sovereign wealth fund Temasek have got together to announce a joint venture. It's called Partier, and Partier would be a wholesale blockchain-based payment network for cross-border transactions. It was sort of talked about a couple of months ago, but now it's really becoming a thing. Multi-currency clearing, settlement solution, 24/7, instant settlement, atomicity. Both payment legs will succeed and fail at a real-time basis. There'll be very little risk or delay because of the way the whole thing being architected. It would be one more interesting thing that's happening, and it's the very latest that's happening in Asia. So I just wanted to share that with you before I talk about my subject matter, which is CBDCs. All right. I'm having a hard time changing the slides. Okay, here we go. The first issue in terms of the CBDCs and all the momentum. So you sort of heard about a little bit of this from Peter's presentation, that the decentralized ledgers offer a host of opportunities. They also create some complications. So let's look at the pluses and minuses and put them together, and that's where the motivation of a CBDC come in. So, of course, you can have a fiat-based system where you can have cross-border payments. A decentralized ledger can help you sort of a universal platform for moving things around the world without any barrier or friction. And it's not just about your currency, but also foreign currency and exchange, and all that documentation can also be handled very nicely in a decentralized ledger basis. It is still fairly costly, which is why it's a disincentive to some extent. The real-time gross settlement that central banks around the world have, the SWIFT network that we have for cross-border payments, are pretty fast, are pretty secure, and they do get the job done. So what is the CBDC going to solve? I'll talk about this in greater detail, but that's one of the things to keep in mind when you think about why do we need CBDCs and what is the motivation behind that. And then there's a question of, there will be some contestability issue in the payments market that could be reduced as well. The reason I'm pausing is, again, every single time I bring my cursor. Okay, all right, there we go. So what sort of acceleration are we seeing in the CBDC space? BIS has been doing steady surveys of central banks about their interest and the kinds of pilots that they're doing on CBDCs. Even 2-3 years ago, this was just academic, not much going on. People were curious, interested, but beyond Bank of England, Sweden's Riksbank, the PBOC, not a whole lot was going on. It was just academic. Today, more than 80% of central banks are super interested. They're looking over their shoulder to see if developments in the crypto, developments in other countries' CBDCs is about to lap them, if they're going to get left behind, and hence everybody is doing it. And I'll give you a couple of concrete examples of the exciting developments that are happening in Asia on the CBDC space. Now, there are two kinds of central bank digital currencies: wholesale, central bank to commercial banks; retail, central bank to you and I. Central bank to commercial bank, could argue that CBDC has been around for 50 years. It's nothing but electronic money. The way central banks create reserves is by pressing a button and it shows up as their assets and the commercial bank's liabilities in the commercial bank's balance sheet. That has been going on for more than half a century. Central banks do it very, very well. We just don't call it central bank digital currency. We just call it currency or money, or we call it high-powered money. But the retail part is the thing that tantalizes central banks around the world. Can I reach the average person on the street directly if need be? So far, no. You have to go through banks. Today, maybe you could. So, and that, of course, has really intriguing monetary policy implications. We hear a lot about helicopter money. We just want to give people cash. Well, it doesn't happen that seamlessly. You may remember last year when the US government was handing out checks to Americans, a lot of people didn't get it because they just couldn't be reached. Addresses, bank accounts, the checks being issued, all sorts of stuff got in the way. Whereas if you had a mobile phone-based central bank digital currency, I, as a central bank governor, say, let there be $1,000 in everybody's pocket. In a second, it's there. I can say, let that money expire in its value in the next 5 days. It can happen, forcing people to spend the money, which in a way gets rid of the usual conundrum, which is if people are very pessimistic, very worried about the future, you can hand them cash, they do nothing with it, they just hoard it. Whereas if I put a little time bomb with the CBDC I just gave to the public, can you imagine the implication of that? Instant monetary policy transmission, things that you could only dream about, it's now very much possible. And then there's the issue of, beyond the issue of monetary policy option, is payment efficiency, payment safety. These things are far more relevant for emerging market and developing countries. I don't think somebody sitting in Singapore or London today is struggling with payment efficiency. There are lots of options. There are lots of things to do. But somebody sitting in India, somebody sitting in sub-Saharan Africa, still lots of issues related to payment efficiency and payment safety. Think about all the workers who work in cruise ships, who work in construction sites in Dubai, or in tourism sector in Thailand. They're from Bangladesh, they're from Cambodia, they're from the Philippines. How do they send money home? Western Union, bank-to-bank transfer, very expensive, huge margins. EM said economists could really, really make the lives of these people better by coming up with some sort of a CBDC solution. Where does decentralized ledger come into this? I'll explain in a second. But of course, the day-to-day spending, cryptos are clearly not a use case so far. And therefore, again, central banks with their fiat power, with their credibility, may well be the ones that can bring down the cost of transaction through their CBDCs and become more usable on the digital currency end than cryptocurrency, whereas cryptocurrency could very well head into the direction of being something that is used for capital market purposes, for store of value, and maybe a few other applications. All right, moving on from that. And apologies that every single time I do a slide transition, I pause. There we go. So this is the slide that I want to spend the least amount of time, because this is not a presentation about all the things that the Federal Reserve and the ECB and the BOJ are doing. But let's be clear, they're not doing a lot. The US will have Fed Now this year. They're doing some consultation with the public on digital dollar and sort of a fast payment system for consumers is something that will probably become real this year, but this is like baby steps in the world of digital currency, not like very serious stuff. ECB very much focused on debt and deflation and the risk to financial stability from climate change. I personally don't think a digital euro coming up with ways to send benefits to Europeans through a digital currency mean are at the top of Christine Lagarde's agenda. They're studying it. Let's just put it that way. Bank of Japan has been doing some CBDC experiments, but if you were thinking about conservative central banks, they might be number 3 among those 3 super conservative central banks. So again, not a whole lot to write home about. Now, here we come with the more interesting part, my neck of the wood in Asia. Lots of stuff going on. First, the bad news. The bad news is the Indian authorities are actually thinking about banning crypto altogether and not allowing Indian investors to hold cryptocurrencies, transact on cryptocurrencies, and they are basically threatening to put punitive penalties, like put you in jail sort of penalties if they catch you using crypto. They made this seismic announcement a couple of months ago, ran into a huge amount of pushback from Indians who are already using crypto for a variety of purposes, and now they seem to be sort of walking back that threat. But on the crypto side, they remain a bit concerned that as far as money laundering, financing of terrorism, and tax evasion is concerned, that could become a use case, and they probably would want substantial more oversight than anything that is possible right now. So don't be surprised if the Indian authorities remain rather hostile to cryptos. On the CBDC side, again, they're not the most exciting story in Asia. They are thinking about doing a few things. They may want to expand the scope of financial inclusion. India is very keen on reaching its unbanked population. Using a CBDC might be the way. They already have set up bank accounts for all Indians, but still, bank accounts are not that easy because banks are not everywhere. Poor people in rural areas have to spend hours, better part of a day, to go to banks, even if some benefit has been sent to them by the government. And it also has issues related to record keeping and malfeasance. Whereas a direct way, say through a mobile phone, to reach out to every single Indian, I think is very tantalizing for the RBI. Thailand, meanwhile, is way ahead. They have been working on a prototype development project, business development project, and they have got a public-private partnership going on there. It's more or less done, and so much so that their work with the Hong Kong Monetary Authority has captured the attention of regional central banks, and I'll talk about that in greater detail momentarily. Singapore is thinking more of a wholesale CBDC system. Can you have a more efficient system where MAS can intermediate with banks in a more efficient basis? But on retail side, again, Singapore is one of those countries which is very well banked. People are very well tracked by the government. So it's not exactly a problem that India or Thailand needs to solve, that Singapore needs to solve. And then you have the Koreans and the Japanese also, thinking about some pilots and setting up stuff. Okay, this is the exciting part, that the progress that Bank of Thailand and HKMA made seem to be so promising that now you have got China, United Arab Emirates, and the BIS, Bank for International Settlements Innovation Hub, all come together to create what is being called as a mobile bridge for central bankings, multiple bridge for MCBDC, multiple CBDC bridge project. So what's going on there? They want to basically have a bunch of countries like Hong Kong, Thailand, China, UAE join with BIS to create what is known as the Project Intanon Lion Rock. Cross-border payments is the key issue. You will basically have some sort of a corridor network will allow the participating banks in Hong Kong, Thailand primarily, and then the others will join. Funds transfer, FX transaction on a peer-to-peer basis using a distributed ledger technology. And as a result, the financial infrastructure would be central bank to central bank, would certainly cut the number of layers that are associated with cross-border payments. And this will also probably bring in China and its eRMB initiative into the fold, where all these central banks will have their own CBDCs. They will be able to exchange or code their exchange rates across the DLT platform, and then carry out instantaneous cross-border payments for central banking purposes, or the central bank becomes the agent of commercial banks to carry this out. Very credible, very safe sort of a network that is being planned right now. But of course, the really exciting part is China. They got serious with CBDCs, well, more than a year ago, long before COVID came in. And the COVID crisis has not derailed them from carrying out very, very interesting pilots and projects around the region. People get lotteries through that. They, in their mobile phones, have an ECNY wallet, and they get digital money, which they can spend. and when they spend it, they get certain motivational perks along with that. And the authorities are basically seeing how this thing transmits through the entire economy. What does it mean for velocity of transaction? Is it easy? Is it a competition for the really big fintech behemoths in China? Does that actually bring in more efficiency and more competition, brings down the cost of transaction? All those things are being tried out. I think a big launching pad would be the Beijing Winter Olympics in 2022. If you or I have the fortune of going past the COVID wall and going to Beijing for the Olympics, we will all get a chance to download an ECNY wallet, get some free currencies from the government of China, and use that to carry out our transactions. I don't have the time to go over all the things that are going on in China. Maybe I'll bring a few things up in the Q&A session, but the bottom line is that China is, without any question, ahead of any other central bank in the world in the CBDC space. They might have an added motivation, which is they want the rest of the world also to use RMB. And if somebody sitting in Africa can use a Chinese e-wallet to carry out transactions with somebody sitting in China, they will circumvent the entire SWIFT system, which the Chinese don't like or have found it difficult to deal with because the US has weaponized that. It could very well be a big game change from that perspective. All right, my final point. Cambodia, sounds tangential, sounds weird, but I assure you this is also very, very interesting. So one big problem for Cambodians is a lot of them work overseas and have difficulty sending money back home. So the government of Cambodia said, we can come up with a blockchain-based solution to lower the cost of transaction and get the central bank involved. Just forget the banking system. We'll cut out the banking system. If you are sitting in Thailand and you want to send your hard-earned cash in local currency terms from US dollar, for example, I will help you do that. Just download the next time you're in Cambodia, the government of Cambodia e-wallet. It sits on this Japanese blockchain developed by Suramitsu. People with QR code and phone numbers can connect with digital wallets, send money back home to their loved ones instantly. Fiat-backed, immediate transfer, minimal transaction cost, huge benefit for expat Cambodians to send money home. Talk about solving problem, a real problem for the poorest or the hardest working Cambodians who are away from their loved ones thousands of miles and sending money back home. To me, this is where the real promise and application of CBDC comes in. Not just allowing us to speculate or coming up with solutions for wealthy individuals in wealthy countries, but the poor countries of the world where you can leapfrog all sorts of inefficiencies and get to the heart of the matter, which is making people's lives better. I will stop right there. Stuart, back to you.
Fantastic. Listen, from what you've said and also the questions that have been coming in, there are three different directions we can take this. I'm going to bunch things just to make this feasible. Now, Mark Rakatamolata has come in with a question that's on screen. What is the main motivation of China for DCEP? Is it to go after dollar dominance? Now, you mentioned that if there was time, you'd go into what's happening in China a little more. That's one thing that perhaps we can park for a couple minutes. I see that Johannes Google from Austria has come up with something which you touched on about India proposing a law banning digital assets with draconian punishments for holders of such assets. The question really is what is their motivation and what are the implications of this?
Mark, can you hear me clearly?
I can hear you clearly. Hello?
Hi, guys.
Yeah.
Tamar, I can hear you.
Because I sort of Stuart's voice sort of faded toward the end, but I sort of got the question. I see what Mark is asking. The main motivation for China. Look, clearly the Chinese would not want to go out and tell the whole world that we're out to displace the US dollar. They have been making marginal progress in this area in recent years by getting the RMB part of the special drawing rights initiative or system framework of the IMF, but that doesn't really make things any different for them. Vast quantities of trade in the world comes from China, but they're almost all invoiced in the US dollar. People simply find the US dollar more convincing to use. So I think the immediate use and motivation for China is not to displace the dollar. That is, of course, something, if it were to happen, they would welcome, but that's not the immediate use. The immediate use is they want it to be used domestically to put the big tech behemoths of China under some degree of competitive pressure. As you can see in the recent months, both with respect to Alibaba and Tencent, the authorities have become quite a bit tough, and they want to promote more competition. And they feel that these quasi-monopolies are so large that you might need something like CBDC to come in for digital wallet type competition to take place. Beyond that, there is an international argument, even beyond the issue of, even before the issue of dollar supremacy or primacy, which is making the RMB a little more usable without opening up the capital account entirely. So the Chinese basically want to have their cake and eat it too. They don't want a fully convertible RMB. They don't want money to go in and out of China. They feel that's destabilizing. And there's some credit to their argument, actually. If they can keep doing that, so be it. It does keep things a little more stable. Maybe not as efficient, but it's definitely more stable. But CBDC might allow them to maintain that friction, if you will, on the capital account side, and still make case for traders around the world, by that I mean goods traders, to invoice goods in RMB, because then they can have money going back and forth instantaneously without any friction, without any FX risk, without their own currency subject to the US dollar risk. So from that perspective, I think it's there too. I'll stop right there.
Okay, that's really interesting. I'd like to go from China to India, where there's a bit of crackdown happening. You know, what is the motivation of the authorities there
right now?
Sorry? I'm sorry, can you hear me?
So to the organizers, can you guys hear me? I mean, I'm not hearing anything at all right now.
Yeah, we can hear you.
Okay, so I can hear you too. So why can't I hear Stuart?
Stuart, are you there?
Peter, shall I just read out the questions? I mean, since we don't have much time left, and answer them myself? Yeah, let me just go ahead and do it. Let's see. Johannes has a few questions about India banning digital assets. I think I took that on.
Yeah, that was it.
Oh, won't banks get disintermediated if central banks start issuing currencies directly to the public? Look, that's a profound question. Banks will get disintermediated if the central banks start taking on lending and deposit taking responsibilities as well. If you just issue some CBDC that people take and they go and spend it, but whatever balance that they have left over, they go out and deposit in banks, then they're not going to be disintermediating banks. But technology-wise, you could argue that the central banks have the capacity to take in deposits and extend loans. But then the question is, do they want to get into that incredibly boring and difficult job of taking in the deposits of millions of people, managing their accounts, dealing with customer service questions, and they're coming up with, a program where they have millions and millions of credit assessors who go out and carry out credit decisions and lending decisions. I think the central banks are not interested in that. But to the extent that there'll be some disintermediation in the form of issuing currency, yeah, for sure. I'm going to go through the questions. Peter, if you have any questions, you can also feel free to flag it. Ernest Lowe has a question. In Singapore, we have Pay Now. In terms of CBDC, what are the differences and efficiencies? So Ernest, in terms of Pay Now, it's a bank-to-bank system. You have a few non-banks in it, but a CBDC in theory, and the way we're seeing it happen in China, will be system-wide. Everybody can make payments. Everybody can be part of it. There will be far less of a guardrail in place. And of course, the central bank oversight will be there, whereas now Pay Now is something under the aegis of the banking system. The MAS has a view, but as a perspective and oversight of that, but they're not necessarily in charge of sending cash to people and issuing tech solutions like an eRMB wallet that the Chinese are doing. So that's the sort of difference I would say is there. Zahib has a question. From an economic standpoint, how does a CBDC tie into traditional money supply? Will issuing X billion of ECNY into the very good question would increase the money supply in a traditional sense? Well, it will and it will not. Sorry about the double-handed answer. Think about it this way. On a fractional reserve system, the way it works is that if I issue $10 worth of high-powered money to the banking system, the banks, because of the fractional reserve system, can go out and lend 100. So the multiplier is there because of the way central bank to commercial bank relationship work, right? That's not the way it's going to happen when a central bank issues directly a dollar to somebody else. Can I just pause and check with everybody? Can you guys hear everything I'm saying?
We can hear you.
Peter, Stuart?
Yeah.
Okay, all right. Everybody's audio is breaking up, so I am hoping that everything I'm saying is intelligible. And so anyway, I hope you heard my answer. It was a terrific question. Okay, good. Are central banks equipped to do KYC? They are equipped, but do they want to? It's so much work, and it opens up to so many different headaches, from unhappy customers to person by person customer service issues, and all sorts of sort of art and science of credit. At the end of the day, credit risk is not 100% science, which is why we still have human beings making credit risk decisions, which is why, because there is always some degree of information asymmetry between the lender and the borrower, and people sometimes want to face the potential borrower and try to get a sense of what they want and what their motivations are, which is sometimes not available just from the hard cold data that is out there with respect to people's credit history. So which is why I also don't think the central banks are interested, but be very clear that the central banks are heading in that direction. CBDCs, cross-border payments, all these things that are going on, in a way, there are elements of KYC and AML CFT in there. So like it or not, they might have to get involved in it to some extent. Stuart, do we have you back? Do you want to run the last bit? If not, okay, we've got 3 minutes left. I'll keep chugging through these questions. Earlier, there was a question about crypto exchanges have been hacked. No, I think that was for you already, right?
Yeah, I already answered that one. Yeah.
Yeah, you already answered that. Okay, I guess Charlie's question is the only one that we have left. Will the launch of CBDCs render other fiat-backed stablecoins redundant? Fiat-backed stablecoin, what does it mean? And is it a new thing, or has it been around for a long, long time? So BIS head Augustin Carstens pointed this out to me last year, that way back in the 1600s, Bank of Amsterdam had a stablecoin. It was copper-backed. The Dutch East India Company was out around the world making, colonial expansion, and they needed lots of money. And Bank of Amsterdam was a big creditor to them. They were lending them money. To keep the entire system credible for about 150 years, Bank of Amsterdam maintained a copper-backed currency that was stable coin, which sort of at one point faced its demise because people simply did not trust Bank of Amsterdam to carry out that operation credibly. I think that in some cases, and credibility is the issue. Banks that want to, central banks that want to establish credibility, countries that want to establish credibility, tech companies that want to establish credibility for payments have the motivation to have some sort of a stable coin type currency issue, which is why Facebook wanted something like that. It was going to be a one-to-one back Libra. So I don't think central banks going into the business necessarily takes those motivations out of the system. People who want a badge of credibility would want to tie themselves to another stable asset. Some people want US dollar to be the backing of the stable coin. Some people want a metal like gold. Other people might come up with other things. So the answer is no. It will not put all other fiat-backed stable coins out of business.
Maybe I quickly jump in here because we're still facing an issue, it seems like, with Stuart. We are already on the end of the webinar, and I want to thank all of the participants. Taimo, for your exciting presentation here. I think it was really exciting. We had still a lot of questions, but also to the audience. Maybe reach out directly to us if you have any additional questions. And also, Peter, thank you for this great presentation, and Stuart. And yeah, we hope we could give you a good overview and insights into those topics, and also hope that you are with us in the next webinars we're conducting like every couple of months. So thank you all. Have a great day, and enjoy the day.